Hey, how's it going everyone? This is Mike with InvestTheory.com. Welcome to episode 1 of our options spread series where we're going to be taking a look at vertical spreads. Now, vertical spreads are just one of many different strategies that can be used in options trading. They can be quite lucrative too. It requires a trader to both buy and sell an option, which allows the trader to enter the spread at a lower cost than buying a single long call or put. Successful option traders like vertical spreads because they often have a lower risk associated with them. They become more appealing than simply buying a long call or put. However, since there's limited risk, there's also a limited amount of profit to be made. Let's take a look and see what makes up a vertical spread. The first thing you should know is that when setting up a vertical spread, that both the buy and the sell option contracts will share the same expiration date. The second thing is that all vertical spreads share the different strike prices. So that means the strike price of the buy and the sell option contracts cannot be the same. They have to be different. Now there are 4 different types of vertical spreads. Knowing how to use each one of these will be strategic in your way of trading. First, let's look at what types there are, and then we'll dive a little bit deeper into each strategy. The first one is the bull call spread. We also have the bear call spread. Third, we've got the bull put spread. And lastly, the bear put spread. These 4 strategies make up the vertical spread family tree. Each one is an important tool in the trader's toolbox. Now let's take a look at each one of these together a little bit deeper. The first one is the bull call spread. As its name suggests, it's a bullish position, and in order to set it up, the trader needs to buy a call option with a lower strike price while simultaneously selling another call option with a higher strike price. Again, both calls will need to have the same expiration date. Now the reason why we would want to set this one up, the bull call spread that is because we believe that the underlying asset or the stock is going to have a moderate increase in value, meaning we think the price is going to go up but not by a lot. So using the bull call spread strategy allows us to enter into this trade with a cheaper overall price than if we bought long calls. Here's a quick diagram that shows how this bull call spread works. Now, let's look at the bear call spread. As its name suggests, it's a bearish setup. When looking at the setup, a bear call spread will buy a call option with a higher strike price, while at the same time selling another call option with a lower strike price. And because it's a vertical spread, we need to have the same expiration date as well. Now, we would want to use this strategy if we believe the underlying asset or the stock is going to have a moderate decrease in value, meaning we think the price of the stock is going to go down just a little bit, but not a lot. Now, this allows us to enter into a short position with limited risk. Here's a quick diagram of how the bear call spread is set up. As we can see, if we want max profit, we want the price of the stock to decrease beyond our sell option. Now, let's take a quick look at the third vertical spread strategy, the bull put spread. This is a bullish strategy and it requires the trader to buy a put option with a lower strike price and simultaneously selling another put option with a higher price. Again, both of these option transactions need to share the same expiration date. Now, the reason why we would want to set up a bull put spread is because we're not really certain how the stock is going to perform. We either believe it's going to have a strong increase in price or it's going to remain neutral and trade sideways. Perhaps we're waiting on some sort of catalyst, and if that catalyst does occur, maybe we think it's not going to really make a difference. So, because we're selling our puts, if the price of the stock increases, we can capture that upward momentum, or if it expires worthless, we can collect the gains due to the time decay. Here's what the bull put spread on the diagram looks like. It's identical to the bull call spread, except of course we're purchasing puts instead of calls. Now our last vertical spread is our bear put spread. As you can tell by its name, it's a bear strategy and it requires a trader to buy a put option with a higher strike price at the same time selling another put option with a lower price. Both of these puts, of course, share the same expiration date. Now, we would want to choose this strategy if we believe the stock will have a strong decrease in price in the short-term future. Using this strategy allows the trader to take on a short position with limited risk and less upfront capital than buying a long put. Here's a diagram and see what I mean. Now, to wrap it all up, vertical spreads are a strategic way to enter into an options trade with less upfront capital. They allow you to capture the momentum in the price, whether it's downwards or upwards, and sometimes even sideways trading, and in return for limited potential losses, the trader will sacrifice some of their profits as well. So vertical spreads are perfect for traders with small accounts looking to manage their risk. Tune into episode 2 where we're going to give an in-depth guide on how to trade the first strategy in vertical spreads, the bull call spread. If you're looking for a knowledgeable and fun community of traders to hang out and share ideas with, look no further. Invest Theory has brought over 3,000 traders just like you together in one free Discord chat. Join by clicking the link in the summary today and see how we can help you become an even better trader. This is Mike with InvestTheory.com, signing out.